Welcome back to this week's market update. Today is Monday, August 24th, 2026, and we'll jump right in. Looking at last week's market performance, stocks fell as rising long-term interest rates weighed on investor sentiment. The Nasdaq Composite led the decline, down more than 2% on the week, followed by the S&P 500, which was down a little more than 1.4%. The Dow Jones Industrial Average was a little more resilient, falling at just 0.85% last week, despite a sharp earnings-related sell-off in Walmart shares. As we briefly touched on in the last slide, one of the downward forces on stocks in recent weeks has been the climb in long-term Treasury yields. More specifically, the 30-year Treasury yield has climbed in recent weeks up to 5.31% last week on Monday, its highest level since 2007. So definitely a cautious move there. You can see even as the Fed has been cutting rates over 2023, 2024, it's continued higher. Several factors are contributing to this move, including growing fiscal concerns and a higher term premium as investors demand greater compensation for this long-term risk of holding U.S. Treasuries. Lingering expectations that the Fed could raise rates before year-end to contain inflation have also contributed to the rise in yields, along with persistent energy prices that could feed into broader inflationary pressures through higher input costs. The growing use of debt to finance AI-related capex is also adding to the supply of debt available to investors, another force pushing yields higher. In response, Treasury Secretary Scott Bessent announced last week that the Treasury Department will double the size of its long-term Treasury buybacks to at least $4 billion per operation beginning in September, in an effort to provide support to the long end of the yield curve. The announcement initially pushed long-term yields sharply lower, although the move quickly faded over the week as investors recognized the small scale of the buybacks compared to the multi-trillion-dollar Treasury market. Long-term Treasury yields will remain an important area to monitor given their broad influence across the economy and financial markets. Moving into some more regular economic data, the Conference Board's leading economic index for the U.S. edged higher in the month of July, marking its fourth consecutive monthly improvement. The increase was supported by improving categories such as building permits, average weekly unemployment claims, and the interest rate spread as the 10-year has been well above the Fed funds rate, as well as the leading credit index. Lower consumer expectations for business conditions here does remain a drag on the index and limited the monthly improvement from being even stronger. The LEI's 6-month growth rate also turned positive for the first time in more than 4 years. Over the 6-month period, the yield curve, stock prices, manufacturers, new orders, and the leading credit index, similar to July, were among the largest positive contributors, while also similar to July, consumer expectations for business conditions remained the most significant headwind to the index. All in all, the improvement provides a constructive signal for the U.S. economy. We'll see that in some of the upcoming slides ahead in the survey of professional forecasters, particularly as the LEI has remained out of this red recessionary territory for over a year now. It was also a big week for major retail earnings here. We had 5 major retailers, Walmart, Target, TJX, Home Depot, and Lowe's, all report earnings for Q2 last week, providing a mixed but generally steady picture of consumer spending. While most beat expectations on top and bottom lines, investors remain focused on very specifically comparable sales growth, as well as forward guidance, leading to some pretty sharp moves across the sector. Starting off with Walmart, they beat expectations and raised guidance, but weaker than expected comparable sales led the stock about 10% lower on the week. On the other hand, Target topped earnings and sales expectations with strong comparable sales growth, unlike Walmart, helping shares gain more than 7% last week. TJX beat earnings estimates, but softer comparable sales and weaker guidance pushed the stock down about 7.5%, Management also reported having some inventory issues with improper inventory at specific stores that also led to the lower comparable sales number. Moving along here, Home Depot delivered another earnings beat, though management noted that housing market weakness continues to weigh on larger home projects. Lowe's beat earnings expectations, but similarly cited continued pressure on discretionary home improvement spending. Both stocks were down just about as much as the market was, less than 1% on the week. Overall, retail spending remains resilient despite July's weaker retail sales report, but consumer preferences do continue to shift, with shoppers becoming more selective across retailers and spending categories. Last but not least, we did get the survey of professional forecasters, as I mentioned in the beginning of the video. Within this, forecasts for real GDP growth were revised higher across the next 4 quarters. You can see 2.5% for Q3, 2.3 for Q4, and then 2.1 for both the first 2 quarters of 2027. Unemployment expectations on the other side were revised lower, so another positive move there to 4.2% for Q3, 4.3 for Q4, and 4.3 pretty much steadily for the next few quarters as well. Then lastly here, payrolls were a bit more mixed here. Payroll growth, you can see expectations were revised lower for Q3, but were revised up for Q4 and Q1 of next year. Then we go back to a negative revision there, although it is definitely stronger than current levels of payroll growth there at 80,000 per month. One last piece within the survey of professional forecasters, we also get the risk of a negative quarter, aka recession odds. That has also been moving in a positive direction, up at 25.1% in the last quarter's reading there. Now the recession odds are down to 13.3% for Q3, falling to 20% for Q4. 21.5 for Q1 of next year, and then also a small downward revision for Q2 of 2027 as well. Altogether, the survey points to a more tempered labor market characterized by slower job growth but limited layoffs, while aggregate economic activity appears to be improving and recession risks continue to decline. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.